Welcome, everyone. Thank you to all of those who have been bearing with us and joined early. Thank you so much for joining our virtual event today, Growth Insights for FinTech Startups and Scale-Ups with Matthew Bright from Zip Business. My name is Emily and I manage all things community down here in our Melbourne hub at Stone & Chalk. We'll jump into it with a little bit of housekeeping. So we understand how important it is for all of you to have your questions answered. So please use the Q&A throughout the session at the bottom of the screen, and we will address these at the end. Thank you to everyone who also submitted questions prior. I will also distribute a really short survey at the end, and it would be really great if you could complete this just to help us make our webinars better in the future. Make sure we get the right topics, content, and speakers. Now about Stone & Chalk. So we have over 70 registered for this event, and I know you all aren't residents of Stone & Chalk. So for those of you new to our virtual space, Stone & Chalk was founded back in 2015 in FinTech, and we're a non-for-profit organisation, and our mission is to nurture, connect, and propel those who are seeking to solve the world's most pressing business and social challenges. In this sense, our startups, corporate and industry partners, investors and mentors are all shaping the future together. We have a proven track record in developing successful growth and support frameworks for founders in the emerging tech sectors. Now, this includes exciting opportunities such as space tech, prop tech, cybersec, medtech, and even ad tech. Now, we have a lot to cover, so we'll jump right into it. Welcome, Matthew Bright. Matthew Bright, as I'm sure many of you know, is the Head of Business Development and Strategic Partnerships at Zip Business, a fast-growing consumer payments company, and Zip's entry into the business space. Now, Matt has spent 4 years building Spotcap in Australia, which Zip acquired in September 2019, integrated, and then relaunched as Zip Business just last August. He's actively involved in Sydney's startup ecosystem and also is a mentor here at Stone & Chalk. We're super happy to have him. He's also an instructor at General Assembly and an expert at WeWork. He holds a Bachelor of Arts and a Masters of Commerce from the University of Sydney with study abroad at Stanford University and Silicon Valley. Now, what will you learn here today? He will outline the market for SME lending in Australia, how to optimize your business model to scale, ways to establish the right brand, product, market, and channel fit, a how-to on knowing your metrics, tips on sourcing and distribution, Matt's approach to enterprise sales, devising strategic partnerships, and far more. And of course, on top of all that, you'll also get insights into Matt's journey, starting at Stone & Chalk, growing, and then the path to maturity and how they eventually became acquired by a listed FinTech unicorn. Over to you, Matt.
Thanks very much, Emily. Great to be here, guys, and thank you for having me. So obviously from the background behind me, Zip's a bit of an interesting, zany tech company. I'm not on holidays in a regional location. So Zip bought us about a year ago, and we started just over 5 years ago at Stone & Chalk in our very early days, based on Bridge Street when Stone & Chalk was just getting up and running in Sydney. So we were one of a few ventures over there that have gone on to do quite well, like Bright in the energy space, Agri-Digital, and Valiant Finance. So look, I'm going to walk you through a bit of a presentation today, and I'm just going to share my screen and I guess take you through how we built Spotcap, a bit of the story to start with, and then some of the lessons behind that more as a focal point. And then we'll just go into some questions, as Emily mentioned. So without further ado, here we go. So how we grew up to become Zip Business. So in the early days, our story was we started basically as a global company, headquartered in Berlin. So interesting operating model of Spotcap Global being headquartered in Berlin with effectively operations in London, Amsterdam, and then we built the Sydney and Auckland operations in this region of the world. So I was the third employee of Spotcap Australia when we were at Stone & Chalk, and started by the former managing director, Lachlan Heusler. And yeah, we basically got up and running. We had a great problem of a well-developed product, a Series B funding round. And yeah, basically the mission was to go out and build the brand, build the company, and get up and running in Australia as quickly as possible. And that kick-started a roller coaster ride of a first year at Stone & Chalk. And then we got up and moved out on our own. So I guess the model for us was, as a global business, we're a balance sheet lender with centralised headquarters in multiple lending markets, with the mission being to empower SMEs with tailored finance, allowing them to focus on what really matters, their business. So we were effectively outsourcing the working capital finance equation of that. And we were, I guess, one of what would be now 5 or 6 lenders that started around that time that have gone on to become the market leaders in this space. Everybody found their natural niche in that market over time. Other names like Prosper and Get Capital and Mulder, etc., are all our peers, and we work together quite closely and compete, I guess, in competition. So we kicked off, I guess, with a minimum viable product of a credit line of, I think it was actually 5K to 250K, unsecured with a personal guarantee, risk-based pricing, quite a sophisticated credit engine, and a 1 to 18 month duration. So a little bit of a smaller loan, I guess, and it gives you a bit of a look, I guess, at our theory on alternative credit and the metrics that we would work with and the tools to do that in what that looks like on the right there in terms of a business database and all of the, I guess, alternative data sets that we look at because we'd look at a company's financials. We would also, our tech would reverse engineer a balance sheet out of their P&L and, we'd look at credit bureau data, etc. So quite a holistic way of assessing credit. So that moves us to where we are today, where we now offer under the Zip Business banner as Zip Business Capital, a working capital loan. It's still a credit line. It now goes up to 500K, unsecured up to 36 months. So we work with quite a mixed spectrum of, wholesalers, retailers, services companies. That's quite a mixed portfolio, and we've built that into the Zip brand and starting to service Zip's merchants and customers as well. So effectively, I guess we had a product that solved a business problem, and we've got some interesting footage here. I think we did really well in building a new brand in market and putting our clients at the core of that. So I'm just going to walk you through a few of these videos to keep it interesting, give you a bit more of a feel of what we actually do. So here's one of our clients, Ryan Short.
My name's Ryan Short from Short Marine. We're a marine service and sales business based out of the Spit in Middle Harbour in Mosman there. We run a 5-star service department covering all parts of marine servicing, from marine mechanical, marine electrical, shipwrights, slipway, anti-fouling, detailing, you name it. And then we've also got a sales side of the business, which we have 2 blue ribbon brands, being Yamaha Outboards and then Brady White Boats, an American imported sports fishing boat. I've grown up boating since I was, 5 years old. So just working on the water every day and dealing with customers that have the same passion in fishing and boating in general. It's just, I love it. And we're dealing with very good products and good people. We've got a team of 22 people now. We had 10 staff about 2 years ago. Given our age, time in business, and being in the marine industry, which banks aren't too fond of financing, it was a great option. Spotcap was recommended to us from our accountants. We initially had the Spotcap funding for a short marine service company, and then asked the question if we'd be able to get another facility for the short marine sales business. And within 48 hours, we not only had an answer of, I think it's possible, put it to the credit team, but it was all approved and it was good to go. What Spotcap does on our service side of the business is allow us to fund and take on bigger jobs, which helps us grow quicker and put on more staff, buy the right materials, machinery, equipment, and take on the 3 or 4 week jobs where we have 30 or 40 grand tied up in that we wouldn't have been able to do before without the funding, because it has too much of an impact on our cash flow. On the sales side of the business, we've got to pay for a boat in full before it leaves the States, and it's at sea for 4 weeks before it lands here, and we get paid by the customer depending on the deal. So having Spotcap available to finance that gap while the boat's at sea, it's just been very, very helpful, because we wouldn't be able to do it without it, basically, and being the most positive financing option for our businesses.
So as you can see from that, I guess what we've built here was a very DIY business. So that video was me making a cameo appearance as I guess a prospective boat buyer, and one of my best mates who normally shoots for alcohol and fashion brands shot that clip. So, we, I guess what we really learned from Stone and Chalk in the early days is hustle and work hard, and I guess constantly try and make a little out of a lot. So Look, just taking you back through our early days there. So we were a founding venture of Stone and Chalk. We went through a series of important things while we were a tenant there. We raised our Series C of $48 million, which is a global raise, of which, probably about a half of that was allocated to us. We grew our staff from 1 to 10 people in less than 12 months. And then Stone and Chalk is really valuable for us in, I guess, dealing with some of their partners and even having as a space to bring our partners in there and build some credibility and some early relationships in, signing key early partnerships with ASX listed companies and industry associations who we still work with today 5 years later. So I think it's a fertile kind of ground for the early days of what you do and now has the industry acknowledgement and that really enhances you as a tenant. So from there we grew up and then we moved out and went out on our own. And look, through the growth phase, we grew the Australian business up to about 25 employees and we'd issued about $200 million in credit, which $130 million was drawn in loans. But by the time that Zip acquired us and we hit four plus years of operations, we were a signatory to AFIA's online Small Business Lenders Code of Lending Conduct or Practice, and pretty key in driving the establishment of that with other groups and lenders like Valent Finance, and which I guess basically this industry matured as we grew, and it got to what is still probably about $1 billion market, shared between 6 or 7 of us as the main balance sheet lenders, a few online marketplaces, and most of us use large finance aggregation groups for distribution, and we work with accounting platforms like Xero or MyOb and through different industry associations. So I'll get you through the partnerships phase and the aggregation group as an important thing shortly. So in the maturity side, Spotcap Global is a business. This is us in Berlin. It's the annual company thing where I think it's about 120 people at that stage between all of our offices. So we certainly got to a certain point of maturity. And I guess in the Australian business, we were 4 years in and wondering what was going to happen in the sense of, okay, 4 years, you're either getting acquired, you're conquering the world, or you're going out of business. And we started an interesting conversation with Zip and it gets us to where we are today. So basically, Zip wanted to move into business lending, and there were went around town and had a few chats, and we found both of us that we had the most complementary fit in terms of credit philosophy, culture, which we found really important in working together today. And we bolted on really well, and it was a simple conversation of could we service the Zip volume outside of Zip, or did it make more sense to make an acquisition, which the size we were at was a decision we all made. So about a year ago now, 6th of September, so Zip announced to the market that that acquired us, and we're using, our experience and capability and technology platform to move into the commercial side. So we're one of several businesses that Zip bought in a short space of time, and there's been a couple since, so it's certainly been an interesting journey to be on. And that we've shot a little bit of a video here of focusing on our acquisition with our current managing director and Zip's chief operating officer and co-founder, which I'll walk you through.
Hi, I'm Simon Keese. I'm the managing director of Spotcap Australia and New Zealand. We've just joined the Zip family. We're one of 3 companies being acquired recently, and we're all going to try and build a really fantastic client-focused proposition to really make a big difference in this marketplace.
Peter Gray, co-founder and director at Zipco. Well, we're particularly excited about the Spotcap opportunity for a number of reasons. I think we saw a market-leading technology platform in terms of underwriting small business customers. So it was become a critical part of the Zip strategy. And obviously we very recently launched ZipBiz, so we're really excited to sort of turbocharge that. We've recently raised some money on market to sort of support these initiatives, and we're very excited to get them underway.
The acquisition of Spotcap by Zip makes really fantastic strategic sense, because we're able to bring the expertise that we have in terms of small businesses into buy now, pay later, and Spotcap's able to realise the benefit of those partnerships that Zip has already acquired. They've got over 20,000 merchants and partners in Australia alone. We've got big growth plans and be able to do more with more small businesses, both here in Australia and New Zealand.
Opportunity as part of the acquisition is supporting the Spotcap Australia team. We take advantage of their current foothold in the small business lending world. I think we bring a significantly larger balance sheet, a significantly larger reach, and a very exciting new brand. So we hope to really be able to support the team, a very capable team. We're very excited about really turbocharging their growth.
So that was in January, and which feels like a lifetime ago today, which I can imagine most people on this call would also agree with. And look, we've rebranded our platform and gone through a bit of a relaunch. So this was, what was once the Spotcap interface is now Zip Business, and we've gone out to market about a month ago and announced the launch of Zip Business, along with, I guess, a couple of other things like an eBay partnership and the debt facility that we've raised to work with, to be funded by Victory Park Capital in the US, which will roll out the initial kind of receivables base for the buy now, pay later product, which is coming out shortly. So it's certainly been a journey for us. And look, it's interesting, going through that rebrand process and the integration. It's certainly, anybody who's ever been through an acquisition knows it's quite a journey. So we're really glad to be on the other side of that. And we found ourselves, funnily enough, I guess, still involved with Stone and Chalk through COVID, in the sense of even shooting our next round of videos to really communicate to our partners the rebrand and that we are the same product. We couldn't actually let external people into our office, so we ended up shooting back at Stone and Chalk. So, this was one of our finance brokers who carries our product.
My name is Mulder. I'm a finance broker. I'm dealing with Spotcap for a while now. We've been successful with a number of transactions with the Spotcap team. Spotcap is becoming Zip Business. We're excited about the new name. I guess it's still the same faces, same BDM, same team, same commission arrangement. From a broker's perspective, not many things will change, and we can't wait to see what Zip Business will bring to the table.
So this was the announcement of what we did with eBay and Zip. So we went out to market, and it's interesting. So the share price jumped 27% on that day on the back of that announcement, which even we were amazed by. So there's certainly a lot of market interest in Zip in general, as you would all know. And I guess any new initiatives that they announce certainly seem to be well received. So yeah, this I guess gives you a bit of a look at how we've fitted in and gone through this acquisition now and become part of the fold, and how small business is now a priority for Zip. And it's interesting. I mean, Larry, who's the CEO and founder of Zip, had actually started consulting at Prosper when he left corporate life, and I think could not have imagined that he would end up going into small business after going through consumer. So it's certainly an interesting time for the Zip people, and we're great to be greatly involved to be a part of that. So I guess what we'll get to here is really the guts of this and the most important things for you guys in terms of, lessons for fintech startups and scale-ups. I mean, we've been through an interesting experience here, and ultimately we never knew where we were going to end up, and nobody ever does. You build a business, you hope that it works, you create a lot of things and make a lot out of a little, and then at some point you end up in a very interesting space. And yeah, look, I think I'm happy to kind of impart any lessons of what we've learned over the years or taught ourselves. So I think the first one here is really around optimizing your business model to scale. I think, if you look at that third quadrant there, it's really interesting in terms of how, I guess, a customer proposition, there's more like 4 interlocking parts in trying to really build a company and what people end up owing their success to. So, you look at a customer value proposition, profit formula, which is your revenues, your cost structure, your margins, your resource velocity, and then your key resources, which is your people, your technology, and your products, and your channels and brand, I guess, and then the processes around that, making products, budgeting, planning, sales and marketing, customer service. I think, successful business models have to have a really exceptionally strong customer value proposition, and a stable, scalable system in which the elements almost mesh together pretty seamlessly to make those work. And if we kick off at the left side there in terms of the market size, the first key growth factor to making your venture work is how big is your market. You scale, you need headroom to grow, but you've got to have a large market to start with. And then you get down to your distribution. Around the markets, we'll get to that in terms of, total addressable markets and serviceable obtainable. That's equally important. But, your distribution is key. It was probably one of the most important things for us in your ability to get your product into the hands of customers it's the key to success in achieving scale and massive distribution is essential just to get that portion of the market that you can obtain. And what then that feeds into is your gross margins, what your percentage of sales that you have to pay for growth. and to reward investors for financing that growth ultimately in the end. But you need your margins as a buffer to constantly have your flywheel really properly turning. And then getting the network effects of that, from, I guess, it's pretty critical to your long-term advantage. Each new node that you add in networks in terms of distribution really adds, I guess, another element of growth. And we found that with partnerships that we worked with, we signed a deal with Australian Finance Group listed on the ASX, and that gave us our initial rollout across the country. Like, I remember working at Stone and Chalk, and that got us out to bits of the country we would physically never get to, like your Darwins or your Toowoomba's. And then I guess other partnerships we added. The second one I did with Connective, Australia's largest home loan finance broker group, which are now merging with AFG, that ended up being one of the biggest growth drivers of our business as we got out of Stone and Chalk. So, in your early days of why you are there at Stone and Chalk, it's really, I guess, putting the groundwork in, things that took 12 to 18 months that I started in Stone and Chalk and then materialized afterwards were really key to our success. And look, what those things then feed into collectively is that product to market fit, which everybody talks about. If your product features are a strong fit with the markets and customers' needs, and you can measure that by usage and retention. If that's not right, you can't really operationally scale your business. You have to have those fits and those early customers, that you can bring in and then cross-sell and scale up and build out to then get into the rest. And look, ultimately that all dictates whether you're whether you're a success or a failure in the end. And, it's a hard formula to get right. But I think, it's really worth thinking about these elements, and we will share this slide deck so that you've got a bit of record of this stuff. So established fit, everybody talks about product and market fit, which is great. But what we found with our product as a financial brand that was unknown, it took us a few years to build the brand. Your channel fit is equally important. And that then feeds into your channel fit, then feeds it into your business model fit, and then the model back to the market. So it's a bit of like a virtuous circle or square of how all of this works. And, products need to be built for channels just as they're designed for customers. So for us, it was super interesting in the sense of, we had this well-funded product, well-designed, go out and build the distribution, and we needed to find the network effect on that. And we worked with large finance broker groups predominantly, and sort of accounting people and intermediaries of small business, and ultimately tried a lot of experiments while we were at Stone and Chalk, everything from sponsoring the Council of Small Business Alliance, doing lots of things. But what we found really worked best is, finding great distribution channel partners that you could work with. And we would, it's really that classic Pareto principle thing of 80-20 that, we get 80% of our business from one channel, which is the finance broking group, the finance broking network around the country, which is about 20,000 brokers carrying our product. And out of those partnerships, we probably do 2/3 of that volume with two parties. So, I guess having that credibility and starting those partnership discussions early while you're at Stone and Chalk can really set your business up for the trajectory that it goes down in the future. And a lot of it, you figure out what's a waste of time and what's going to work and what's not. And also, things you like doing or people you like working with versus, bigger beasts that might be harder work but can often drive your growth. So this gets us into the finance broker space. So that's one of our clients there, Sydney Rocks Brewery in Alexandria. And I think, as we'll get into in the marketing side, that's one of the things we did really well. As an unknown brand, once we actually had distribution and we had data and, whether that's, customers, whether it's our distribution partners, we were able to put the clients at the fore of what we do and profile their businesses in a really interesting way, and actually just get the human side to this story, and also bring the finance brokers along for the ride, because we figured out really early that brokers understand brokers. Everybody's done a client case study, but nobody had really put, the people that were introducing our business to us at the core of what they were doing before particularly well. So, we found it a really great brand builder and a discussion point that, people would talk about and talk to each other about. So, it sort of shows you, I guess, you look at those numbers of a lot of this for us was the largest networks we could find to work with were mortgage brokers, and they would offer their, some of their clients business loans, I guess, as a bit of a value add. But you look at the uptick over that time of, in April 2015, around when we were started, versus where it got to, quite recently, I guess, through September, the small business finance became quite, I guess, a focal point, not just a value add. So things changed over time, and people started dedicated business distribution and etc. Through the large aggregation groups, and we were able to seize on that and get in early and build, I guess, that distribution, which we're able to edge a few other people out. I think, you know, many of you would know Prosper as a successful company. So we were positioned as second to Prosper on a lot of those panels as a more flexible, affordable, you know, financing option. We were a credit line opposed to an immediate loan, bit cheaper, a little bit more selective in who we'd fund. And then that really positioned us having those distribution relationships as other people eventually got distribution. It gave us this really good growth phase of where we had a lot of coverage ourselves, and, you know, the market was really split between 2 rather than 5 or 6 for a while. So look, in terms of building, you know, strategic partnerships, I have the discussion a lot with startups that are asking me. I mean, it's really 4 phases to figuring out who you can work with and how you can work together and what you can actually do. You know, there's the initial phase of market screening. If you don't know who your potential partners are, it really comes down to a lot of research. You know, we were doing a lot of industry association trade fairs early on. So, you know, myself, I left a corporate background to take a startup job. So I didn't have the relationship or networks in these spaces. I built that from scratch and built a brand virtually from scratch as well. So a lot of that comes down to building really strong relationships with, you know, the staff in you know, companies you want to work with. And then I guess just kind of appearing credible and, you know, that you've got a product people are interested in, and, you know, then scoping out, you know, what that actually looks like, which gets you through your evaluation phase. Typically, you know, you'll sign an NDA if people are insistent on that. Not everybody is. You know, and go through a bit of a due diligence in terms of the feasibility of your product, your financial evaluation around your company, how you fit and work together. And then you'll negotiate a distribution deal. For us, you know, a lot of these things were all fairly set out, and we looked at what our commercials were and what theirs were and what we thought we could do. On the legal side, you'll come up with an agreement, you know, set out provisions and rev share and rewards and payment mechanisms, and I guess both sides just protecting their IP. And then the fun really begins as you start to implement that when you've got an agreement. So, you know, you're going through marketing launches, building a sales team. I mean, I had the pleasure, I guess, of Stone & Chalk of pretty much creating a lot of growth, signing these large agreements, then building a sales team and hiring out sales and marketing to then service that. So, you know, we then announce that to the market, and then you really start onboarding your partners, and then it really goes through that growth phase of, you know, sales is just critical to getting your product out there and getting those early wins and revenue, and then almost cross-selling every success when it's pretty early on. And then the day-to-day management of those partnerships. You know, we manage large partner networks. I think we've got about 20,000 potential partners, of which we've worked with about 4,000. And even the large groups, and that's over the years, that's over 5 years. The large groups we work with, like AFG or Connective, are each, you know, collectively it's probably 7,000 brokers. So we've got a lot of data, and we, I guess, try and understand and service that, and work with, we use Power BI and Salesforce in the back end. I'll get a bit more into that in the questions. And then it just becomes the management reporting side and working with those bodies. And again, look, you know, partnership driven business, particularly if you're early stage or you might even have, you know, some initial funding. You know, we had it enabled us to propel our business, and it's still the core of what we do today. Which just gives you a bit of an example here. So this is Connective, our best partnership we've ever done, I would say. And again, we put a human side to this. This is Brent, who's having a bit of a laugh on camera on the left-hand side here, and Tony from JK Finance, who was an early broker of ours in Melbourne, who started pushing out the product through his network. This just takes you a bit, I guess, a little bit through our partners' view of our product and our space. And we were able to push this out through, you know, through EDM to a lot of people. And I guess it was just, we asked whether they would do this, and we put a human face to it and put it on camera, and it worked.
Connective is Australia's largest mortgage aggregator. We've been in operation for about 15 years now. I'm very keen to work with our brokers and helping them understand the diversification opportunities that are out there in their own businesses. I really do think it's important they do diversify. But the most expensive purchase a client's ever going to make is going to be their home. It stands to reason that if they've trusted you with the home loan, they're going to trust you with an SME loan. One of the biggest things that we see is brokers being able to tap into their existing databases and understanding the many facets of lending that are available to them. In the unsecured SME space or fintech space, what we're seeing from these lenders is that at the moment they only really equate for 1% of all the small business lending that's actually being written in the marketplace. Now this is actually the start of a multi-billion-dollar industry that our brokers can actually get in on at the ground level and watch it grow as they actually help their clients through these processes. I've spoken to a lot of brokers over the years, and I suppose one of the biggest things for a typical mortgage broker is the fear of actually doing something outside of their norm. What they need to do is understand that it's actually not that hard. It's it's actually quite straightforward. With the systems that Spotcap provide and also the support from their BDM network, they're there to hold their hand, walk them through it, and make sure that the outcome is the best for both the broker and the client at the end of the day. Since Spotcap's been on board with the Connective panel, they've actually been fantastic to work with. They're a great bunch of guys. They know what they're talking about, and they're there to help our brokers succeed in their businesses by providing opportunities that allows them to diversify out in the marketplace. As a broker, if you've got a client whose business is profitable and you want to help them grow that business on a year-on-year trend, then I would definitely recommend calling Spotcap. Connect. My name is.
So just to put that in perspective, it took me 14 months to get that partnership deal happening. That started out of a conversation at an event while we were still based at Stone and Chalk, and Brent visited us a couple of times in Sydney, and look, we built some credibility, and eventually that became one of the main drivers of our business. So yeah, look, I guess just to get to run, how to actually run one of these large partnerships, look, your network is really a total number of partners. You've got an activation rate of how many people you can actually get working with. You've got an attrition rate of people that might drop off over time. Gradually, your network that's active really changes. And, it might be, the channels are going to be divided by or segmented by geography, by type. And that there is definitely a length of time and cost of recruitment and onboarding and figuring out, where your hard work and blood, sweat and tears, what that's actually going into to build your distribution platform and the yield from that. I guess getting a large partnership is quite a long sales cycle, but then the sales cycles of individual brokers referring your deals are quite short and quite quick. And you want to figure out your average value of what those deals look like, your acceptance rate, and just getting an understanding of the metrics around what you're doing. So, I would encourage anybody who has got an early stage startup now to really figure out where the large distribution channels are that can drive things for you. There's only so much you can do in terms of your own headcount and labour, and you're obviously split between working on the tech side, on the exec side, on the management side, and and the sales side. So I think if you're a startup under 5 people, and it doesn't matter what your product is, it's just figure out where you can get distribution. And, I've had talks at Stone and Chalk with other people, whether that was with pet insurance, which I was suggesting vets, etc. There's whatever your product is, there's definitely a large distribution network out there for you. It's just how you can figure out who that is and get towards some sort of reach out and deal. So yeah, look, on the marketing side, obviously from the videos you can see we've been quite strong on the marketing and building a human face to our brand, which was started as a bit of an unknown brand, and it always probably takes you 2 to 3 years to get that brand recognition. This gives you a bit of a look, I guess, at a sketch from a creative agency we engaged early on, and it actually fed into what we do quite well, because the agency looked at all of our competitors and us and just said there's no difference between any of you on your websites. So why don't we actually focus on what you actually do? And this gives you an idea of, focusing on what people were using with the use of, what clients were buying with the use of proceeds, which we shot in other videos of whether that was machinery or different things, and, building that understanding of what we do, because online small business loans was a little bit opaque and misunderstood. So, I think there's a really good quote from Matthew Brymer, the founder of General Assembly, which was, globalize infrastructure, localize creativity. And that's what we did with our business and made it very Australian, I guess, for a European product. So yeah, look, I guess getting back into the metric side of things, you really need to know your metrics back to front. And it almost doesn't matter what stage you're at, whether you're really early on or whether you're further down the line, because when you're trying to raise venture capital, these are the questions that are going to be asked from you. So you want to know, really, how large is your total addressable market, like the maximum market size itself, what the serviceable available market around that is, and, okay, what if we take that down a notch, how big is the medium sort of market size of a market you could possibly reach? And then what is the serviceable obtainable market? What sort of volume of business do you think you can actually really write and get that as close to as possible? I mean, we, out of a market, you could look at this as there's 2.3 million small businesses in Australia. However many have actually sought out to take out an alternative finance has ended up in $1 billion market of which we would kind of generate X per year. So that gives you, I guess, the drill down phase of that. And projecting your market share, like how much of that market do you think you can take? What's your average revenue per user? So for instance, our average credit line size is about 100 grand and our average loan size is about 60. So knowing those things really drives you, and there's always going to be some degree of variance. I mean, we fund loans up to 500K. We'll certainly see a few of those deals. It's not going to be your average deal. And then it drills down into your customer acquisition costs. How much does it cost you to acquire a client? So for us, working with large aggregation groups, we pay them an ongoing fee. We would pay our finance brokers 3% on the first settled deal, 1.5% thereafter. So how that then fits into how much, then your cost base, basically, what's it costing you for your headcount with your salaries, attending events, travel when you actually can again. And what does that look like in a raw number of how much it's costing you to acquire a customer and what you need to do around that? And then retention, what's your lifetime customer value? Who can you hold on to? So, we recently shot another case study with one of our clients, who's a forklift business on the Northern Beaches in Sydney, who client of ours for 3.5 years and had come back 7 times. So it's those clients that you want to hold on to, and your unit economics are really dictated around, making that stuff work. So some final lessons here from me. I think in the early days, as we did at Stone and Chalk, you really want to sell hard to keep the lights on, build your brand, make friends fast, have a bit of a vision and a mission and get that moving, which is the hardest part. It's probably the phase a lot of you are in. And, in your partnerships, you're really trying to find like-minded people in, complementary places and grow together. So for out of that, I guess the example here with Connective, Brent, he's a good mate of mine. People grow through organisations at different stages and times, and that really dictates, I guess, how things turn out in the end. Ultimately, people want to work with people they like your product, but they probably want to know you more as a person. And in terms of corporate engagement, you really want to estimate and qualify and to work on big deals at the same time as getting early sales, which I think for us, you're able to build some street cred, you're able to keep the lights on, you're also able to look at the bigger picture that takes shape over time. I would say in hiring, actively seek out generalists and outliers, people of different backgrounds with pretty complementary skill sets. I think, the more niche you go in the early days, the less suited it is to an early stage venture. You really want sort of online marketing people that are across a lot of different systems versus people that are versed in particular things. I mean, obviously, on the code side, that might depend. You might have a specific language that you're hiring developers for, and then just hire some people because in the early days, people are the face of your brand. And a lot of it comes down to instincts, trust your gut. I think follow your instincts gets you a certain way in life in this type of venture, and ultimately it can work out well. So that's the guts of the lesson side of things, and ultimately have fun, enjoy it. Startups are hard work, but they can work, and they're certainly good fun. So I wish you all the best in that regard. And we'll get into some of the questions. Emily, feel free to chime in here. I know you'll probably have a few questions from the live question side of things, but I'll just kick off answering a few here. So what are the best software tools and practices you recommend for a fintech startup? Look, I would say for everybody, most large tech brands that you want to work with their infrastructure like Salesforce, will offer like a Salesforce for startups. Like I think often the cost might be higher for a good product than a bad product at a lower level, but you're almost better off designing your infrastructure around the good and get it right early and just pay a mild premium to do that, because as you scale, you'll find the systems are there that you can gradually increase as you scale up as well. I don't think there's, it's really going to depend on, I guess, what you do. But for us, we use Salesforce in the front end, we use Power BI in the back end. We've got our own platform that we've just integrated into Zip. Everything, all comms, all kind of materials, we're all in a G Suite. So nothing that fintech startups wouldn't already be looking at using. But yeah, often you can also find somebody, a bit of a rep at Salesforce or wherever else that will be willing to help you. And, that I would include most enterprise brands in that category. What are the 3 golden rules that must not be broken when scaling a fintech? I would actually probably look at this as, when we were building this thing, we kind of looked at fintechs as a 3-legged stool, where there's always, one leg that's kind of off. And, that might be in funding, people, product, distribution. Things are never perfect. So you're constantly moving from one pillar to the other to try and keep the machine moving, or the chair stable, I guess. So that's our view of that. And I think that's probably true for most of these ventures.
Just jumping in, sorry, Matt.
Yeah.
To whoever asked if you can have the video sent afterwards, we will send the video and the slides as mentioned. And please do jump in with any questions, guys. We do have still 20 minutes, so you can go real deep here and get in the queue. Back over to you, Matt.
Cool. I'll just kick off. I'll continue just answering these until anybody jumps in. But are you thinking of international expansion? So I guess for those that have followed Zip, we acquired a company called QuadPay in the US and moved into the US. So now we're active in all Anglo-Saxon markets on the consumer side. So, look, Australia's a great test market. So Zip Business will roll out here first and see how the buy now, pay later product goes, and then possibly introduce that into later markets. TBC. Can you please comment on the challenges of assessing SME credit risk in the current environment? It's a really good question. So, look, SME credit is an interesting thing in its own right. When times are good, it's very easy to assess. When times are bad, you don't really want to completely decline people, but you certainly see people struggle and applications get a little bit problematic. It's funny, right? Like if you're a bank, you can effectively bundle SME or buffered by your other portfolios, whether that's consumer or mortgages or that side. If you've got a pure exposure in SME in a downturn, you can certainly go to a dark place, which we're fortunate not to, because we've had quite a clean portfolio and credit profile. We know peers who've disappeared and been acquired where, 40-50% of their portfolio went into hardship. So we found, I guess, in terms of new people applying to us, look, there's businesses that legitimately need the capital that you cannot lend to just because, the quality is really poor. There's really still thriving sectors, particularly, I guess, in industrial companies that are unaffected or people with long-term duration contracts. We're even starting to see hospitality come out of its negative phase of, people that did have other streams of revenue like Uber Eats, etc. Has certainly been, they've managed to survive and then turn it around depending on what state they're in. Probably not Victoria, unfortunately. But yeah, look, it's really interesting to see what will emerge out of this and how we can support existing clients and partners and continue to fund, interesting clients. I think, we saw clients with hypergrowth. There was another video case study we shot of with a finance broker who referred a hand sanitizer client to us, and they had pallets sitting on the docks that needed funding to then get them into shopping centres into their customers, and they've never seen so much growth. So there's always interesting stories out there.
Very much so. I'll just jump in because it fits in quite nicely. One from Jennifer early on, I think we've definitely touched on it. But so risk-based pricing means you accept all borrowers, or do you say no to some borrowers? You definitely mentioned you do say no to some, but can you maybe just expand a little bit more on who you do say no to and
Sure thing.
Yeah.
So look, typically we'll say no to people who don't meet our minimum criteria of 18 months of operations and a couple $100,000 of turnover. So, we'll get the odd one there. In terms of clients that are applying to us, they might be asking for too much or they're still a little bit too early. We would also maybe not decline them, but we might offer them a lower amount. We will outright decline people who have terrible credit, etc. I mean, there's unfortunately always a place for those deals through other lenders at high rates. But, we like to build good repeat business with creditworthy clients. So it's more, we like to identify good prospects to work with. So, of course, you're going to have a slightly higher decline rate in that respect.
We also have a couple more on that same line, just coming off the SME back. So what data sources are the best for determining SME credit risk?
Good question. So we look at things several ways. So, there's what you're telling the government on your BAS statements. There's what your bank accountants statements say. There's, what your financials say. And then the real true accurate picture for us is we make a bank account connection and then assess that data. So we at the moment, we screen scrape, we use that data. Obviously that's changing with other peer lenders in terms of open banking coming into effect now. So there'll be more direct access to data. But historically, I mean, we've already been doing this since we started. So we would assess that data. I think, as I mentioned, what our tech does is actually reverse engineer a profit and loss statement out of that data. So, we're looking at, what we see the reporting side look like, what the actual cash flow balance looks like in a bank account. And then that's what we're really looking at the serviceability for. So, we might have a client looking to borrow, let's say 200K. We would look at the serviceability and go, okay, we look at this as you being able to comfortably service 120, 130K and extend that offer. So that's how we work on the data side. I might just also answer this one before you jump in. So challenges of an offshore parent company. So look, it's hard work. Time zones, work profiles. I mean, we've been fairly autonomous in Australia, but still you're reliant on developers and tech side stuff. So having late conversations at night, it does become a little bit regular. So the more Australianised you are, the better off you are.
Awesome. Another one from Sophia. So do you think the SME lending space is saturated in Australia, and therefore should fintechs be niche to serve specific areas of the market, such as retail, etc.?
It's a very good question. It definitely is saturated. I mean, you look at, like I think, as I said in the presentation, our peer lenders, everybody's found their natural niche and place. But, we grew 5 years ago from a product, I guess, attached to a solution that was really underserviced in Australia. So I think I certainly wouldn't be starting an online SME lender now. If anybody is, you really need something compelling and very different. But that then, I guess, feeds into how the markets change because, even if you look at this year where I think it was one of the card companies that acquired Cabbage in the US, OnDeck was bought by consumer fintech, and OnDeck was the pioneer in this space in the US post GFC, and we were acquired by Zip last year. So what's happened is actually this convergence between consumer payments companies and lenders. And you look in the US, companies like Square, they have Square Capital to support their merchants. I think from a market that's definitely consolidating and changing, the more that I guess we wouldn't have expected our peer lenders to start buy now, pay later products. We would never have imagined a buy now, pay later product acquiring us. So you start seeing markets change and converge. And I think Sophia's probably right that if you were going to do something industry focused, there's certainly room for movement. I mean, you look at Zip and we're retail focused. So we, I guess, both Zip and Afterpay and Hum now are building their businesses around merchants. I think the more customer or client or partner centric you can be, you need to find yourself something you can attach yourself to and build distribution quickly, and then it gives you a bit of a toehold around the infrastructure in that market.
That's a great answer. Thanks, Matt. I think we'll jump back to your questions before we go for a few more live.
Cool. Okay, so what was the hardest decision you needed to make on your journey, and how did it turn out? It's interesting. I couldn't point to a singular decision. I think early on the distribution side, I think the decision there was for us to focus on finance brokers in getting an early distribution channel. That was and that panned out really, really well. As I said, that gave us a bit of a, I guess, oligopoly position in space where we had some degree of control over distribution and really important relationships that we could build, which probably boxed out other competitors that tried different strategies in going direct to customer or just leaving things too late. So timing really fed into that. I think ultimately, I guess other decisions, I mean, obviously to sell to Zip was a reasonably big one, and that certainly turned out really well. It probably saved us from a world of pain in SME lending this year, being buffered by a buy now, pay later operator.
About timing,
Life's timing. It's really interesting, right? Like you make these decisions, you've got some idea of how you think they're going to turn out, and then the world fundamentally changes. You don't really know. But I think you're constantly adjusting your course in these ventures where they're uncertain. You can kind of see the waters, but you can't see the waves, I guess, and you're the little boat out there. So yeah, it's that'd probably be my answer to that one. What's next for Zip Business? So for us, it's really properly launching. I mean, obviously we've only announced to the market a month ago after going through a full integration over the course of a year and rebranding as Zip Business. And, I guess to give you a bit of an insight, a lot went into even coming up with the name. What do you actually call yourself? So we looked at all the branding conventions of other, consumer tech companies that had gone into the commercial space. So whether that's, Uber for business, Airbnb for business. Do we call ourselves Zip for business? Do we call ourselves Zip Business, Zip Biz? We went through all those the naming conventions and then product constructs around that. So for us, I guess the final quarter of this year is launching the buy now, pay later products, and it's an interesting time. Like there's going to be a good winding year ahead of positive things happening.
That's awesome. Just on that one, we also have a question. Can you talk more about the Zip Buy Now, Pay Later product?
I would love to, but you can probably look at the existing ASX filings. I can't really comment on that any further at this point, being a public company. So you can wait for the announcements.
Watch this space. We'll come soon.
Exactly.
No, that's awesome. And we've got another one basically on the customer experience side of things. So jumping back to the start of your journey. So did you build the customer experience that you wanted initially and then build the product service offering up front? Or did you incrementally improve as you got the customer feedback? And you did say that, you know, you thought it is better to invest up front and go all in, but yeah, how did you guys go?
It's a good question. So I guess with our MVP, we had it designed around what customers, what we had in mind that they needed. I think, again, it's pretty nuanced based on the geography that you're working in. So we had a European design product that we were working with in Australia. And, you know, I think we certainly did refine it over time, and we've refined it even further in Zip. A lot of it comes down to resources. I mean, the resources we've got at our disposal here and time, like, I think, as I mentioned, a lot of this being very DIY, where, you know, it's amazing having the resources of a large corporate behind you, as opposed to, you know, don't get me wrong, it was certainly fun, you know, throwing a mate and his dog in the car and doing client and partner case studies and then producing it, slapping a logo on and pushing it out, which is great. So I think, you know, in terms of the product side of that, I think we figured out what we thought people needed and then changed that over time. And then you constantly want to come back to that because, you know, even now it's like we've just gone through a bit of a phase of, okay, so, you know, we're hopefully through a decent portion of the corona, you know, impinging on the economy. So what do clients actually need after this? You know, we've worked with our clients in hardship and given them, you know, I guess, interest relief or, I guess, you know, loans issued under the government's SME guarantee. We're just getting into the second phase of that now, which will look different. So it's like, you know, I guess society changes, people's needs change, products need to change with them, and you're continually trying to rewrite the script on that and keep that, you know, alignment together.
No, definitely important in this ever-changing and accelerating changing environment, hey?
Interesting and strange times, as in inverted commas, yeah.
That's for sure. I think you've got one more question, is that right?
Let me have a look. I think that could be it.
Oh, there we go. Well, we've got one last one from Giovanni. What are some fintechs in general either doing or not doing wrong from your observation? Very broad question, lots of room for commentary, but is there any sort of key cases or things you can comment on there?
It's a good question. Let me just think about this out loud and anchor it in a couple of examples. Look, I think not to make this about us, but I think what companies like Zip are doing, you know, Zip's been a listed company for 5 years. They're going through this really mature growth phase now of, you know, turning themselves into quite a large global payments company quickly. I think other listed companies like Wiser on the personal lending side are doing well. You know, they've been listed for a couple of years, I think now. You know, you're starting to see, I mean, look, the fact that we were an unlisted fintech being acquired by a listed fintech already shows like a degree of maturity in Australia as a market. So I think, you know, in the larger end of town, there's certainly like high growth, high value things happening. And then, you know, beneath that, you know, on the startup side of things, you know, you're starting to see, if I think about Stone and Short, particularly in Sydney, there'd be like a higher attrition of things that don't work now than things that didn't work a few years ago, where people would tend to hang around a little bit longer. It would take them a little bit longer to fail. I think people have, like fintech entrepreneurs and startups and scale-ups got a lot more dynamic and working faster and harder to make things work quickly, which is just really crucial to, you know, these are hard things. So, you know, having the support of Stone and Chalk and using the resources around you to get moving, you know, really quickly, there are interesting products coming out. So, yeah, no, I think it's a really good time, and out of this environment, it's only going to be better. You know, you obviously, you know, you look at other people trying to list. You know, Plenty listed last week, which was, you know, RateSetter rebadged in a bit of a tough week for them, I think. You look at, you know, God, there's a couple of others that are waiting in the wings now. Like, there's a huge appetite for fintech investment. Obviously, any e-commerce business is doing really, really well out of a recession wrapped in a pandemic. So there's certainly, like, this will probably only increase the, like, investor appetite for interesting things. So I would encourage people to really double down on trying to pique the interest of investors if that's what you're looking for at this stage.
Definitely good observations and advice right there, especially with the 800 million announcement from the government backing fintech and emerging tech yesterday, as well as lots of investors opening their books looking for good acquisitions.